go, but I want to give you the notice that, of course, we're being recorded by video recording. And that has started. And the next step is to do our roll call. So could we proceed with that?
Good morning. All right. Carl England is absent. Mark Nonig.
Here.
Jack Prothero.
Here.
Terry Cohey.
Here.
Bruce Nelson.
Here.
Diane Fladmo.
Here.
Maggie Peterson.
Here.
Jeff Greenfield.
Here.
Jim Edwards.
Here.
Senator Thomas. Representative Hamilton.
Here.
Okay, we do have a quorum.
Okay, and we have a quorum, so we're ready to proceed and we can vote if we have to. The next part of the thing is to ask for public comment. So is there anybody on the line or in person that would want to make a comment to the board at this time? Hearing none, we'll proceed with the agenda. Do you have anything for us, Dan, first? Any reports on behavior at dinner or anything?
Bond was made out of the cash asset class, so we'll be rebalancing this morning and things should proceed well otherwise, Mr. Chairman.
Very good. So we've got a couple new private investment commitments. So Michael and Thomas are going to do that. John, do you want to introduce them or are they just going to go?
I think we'll just let them go. I think Thomas is going to do all three.
Oh, okay.
So, Thomas, take it away.
Thank you, John. Thank you, Mr. Chairman, members of the board. Welcome. I hope you can hear me all right. Not as remote as Louise yesterday, of course, but certainly not in the office. I believe we are behind tab 8. We had 3 new commitments over the recent quarter, and I'll walk you through those. I'll start with Axiom Asia Fund 6, where we committed $40 million. Similar to the previous fund was also a $40 million commitment. Axiom is a high conviction relationship for us, as you can see on the board brief. It dates back to over a decade. Axiom is a fund-of-fund investor that invests in about 20 to 25 underlying local Asian private equity managers across all stages of economic development. What we really like about Axiom is, for one, the diversification that we're gaining through the fund-of-fund strategy. We're able to access 3 to 4 different vintages with each Axiom fund investment, so that helps us diversify that portfolio. Second, we are gaining access to local teams that really have an advantage in their home markets, and that would be otherwise difficult for us to access, underwrite, and due diligence, simply due to travel and sometimes even language barriers, of course. And third, the multi-geographical access that we're gaining through Axiom, through Asia as a whole, as a region, which is home to some of the fastest growing economies. And of course, a strong, stable, emerging middle class, a growing middle class that should lead to tremendous investment opportunities go forward, specifically in private markets. Just maybe a quick note on the due diligence process, given where we are with the coronavirus pandemic and travel restrictions and so forth. As I mentioned, Axiom dates back over a decade. We know that team very, very well. Just to summarize, over the past 3 years, Axiom has been in Helena 2 times, I believe. Staff has done full on-site visits at their headquarters, and we participate in every single AGM annual meeting. And this year, of course, there will be a virtual format. I'll open up for any questions and comments on Axiom Asia Fund 6.
So I just have a question. Their IRR is pretty darn good. Is the local knowledge account for them doing so well, or what would you say would be a headline why they're so successful?
Successful. Axiom as a whole, they're very deep, very experienced, have a long track record of investing in Asia, in direct funds, in direct deals, as well as this fund-to-fund format. So that contributes certainly to their strong track record. Thanks for pointing it out. I didn't want to brag about it too much. The local managers, of course, have advantages in their home markets. They're able to take advantage of inefficiencies that other folks, for example, a global firm from New York would not have the same knowledge and same access to these smaller markets, inefficient markets. So that certainly contributes as well.
Thank you.
It's Michael here. I would just quickly add, this is a look behind the scenes that, it's locals working with locals. They speak every language of every country they invest in, with the exception of Vietnam, which I joke about with them. But really, they're in the markets that they're investing in. It's not, an American from New York trying to do business in South Korea or in Japan. And so they have very long-standing relationships, especially from their careers at GIC, which is one of the largest pensions in Asia. So they have that local knowledge, the speaking language, and the relationships.
Okay, any other questions? I'm hearing none, and I'll move on to the next board brief. That's Golden Tree Co-Invest, Distressed Co-Invest Fund 3, which is also a re-up, or maybe I should say more of a follow-on investment. If you recall, we committed $50 million to Golden Tree Distressed Fund 3 last year. Golden Tree, a stressed credit investor, taking advantage of global credit market dislocations. Prime example, as we've just seen, due to the coronavirus pandemic, we saw a strong dislocation in credit markets. John Putnam can probably tell you all about it. And Golden Tree deployed Fund 3 relatively quickly, put a lot of money to work in that environment that we saw in March, April, May, and decided that there is excess capacity. So they launched this follow-on vehicle, which invests alongside Fund 3 that we invested last year. Wanted to highlight maybe just a couple points here. As you see, the carried interest and management fee relatively low. That is due to the fact that we were existing investors in Golden Tree, and the ability of staff to move very, very quickly in the underwriting process. We were able to take that advantage of first close discounts, where the management fee was discounted by 25 basis points to 50 basis points, and carried interest is also lower than your standard 20% that you usually see. We like about Golden Tree, really, it's a 20-year credit market veteran with a very successful track record. What stood out to us most when we were on site last year, Michael and I, was this compliance culture. It's really ingrained in the manager. These folks have a dedicated legal operations team. No trade gets approved until all 3 people have to sign off of everything. This is a very compliance-focused culture. And of course, it's a truly global, opportunistic manager that can be very nimble and access credit market dislocations all around the globe. The strong track record I was talking about, you can't really see that on our board brief. Fund 3 is relatively early days, but the previous 2 funds of the same strategy averaging about a 10% net of fees return to LPs, something very strong and something that we expect from Golden Tree go forward. Same here, open up for any questions, comments.
Just, I know we're consolidating some of our holdings in private equity to the managers we feel most comfortable with. Do we have a top limit on how much we would invest with anybody? That's maybe to you, John.
I think we do. Clearly we have within policy, there's, I guess, a 5% limit on any individual manager. We're certainly nowhere near that for any of these managers. I tend to think kind of in round numbers of, 100 million is roughly, say, a 1% position total pension portfolio, probably a little less at this point since we're up a bit over the last quarter. I don't have it off the top of my head, but we have looked. I don't think any manager accounts for much more than 1%. And in this world, of course, you get the interesting dynamic of, we may make commitments to somebody, but they don't have that much money in the ground, and it's kind of this rolling, if you've got a manager that you're going to fund 3, 4, and 5 or something, money's coming back as money's then maybe getting redeployed into the next fund. So, I think 1%, maybe 2% is, probably 2% is probably kind of my soft max in my head where I would start to get uncomfortable. I think going higher than that with somebody. And I don't think we're anywhere close to that across the board.
Okay, any other questions, comments? I will move on to the third one and last one on the agenda here for tab 8. That is OCP Asia Fund 4. Also a high conviction re-up opportunity for us, to your point, Jack, consolidating the exposure to certain manager names. We committed another $50 million here to Fund 4, which averages out our commitments over the past 3 funds to about $50 million. The last one, Fund 3, was a little bit of an outsized commitment, simply to increase our overall allocation to private debt credit type strategies in 2018. OCP Asia, direct lending strategy, similar to some other names that we have in the portfolio in the US, focusing on senior secured loans, first lien loans to family businesses or small businesses all throughout Asia Pacific as a region, as a whole again. It really made a name for being a discreet, reliable, flexible lender to these smaller businesses in Asia that are usually in markets where there might not be a bank lending market existent, or it might be too expensive. Private equity solutions might be cost prohibitive for these folks. So that's where OCP steps in and is really able to provide custom solutions for borrowers in that region. We like that current yield and income focus of the strategy. Most of OCP's loans have a contractual cash yield of an average about 10% built in. So that really has resulted in a stable cash flow or return flow for Montana. And of course, similar to Axiom, we're gaining access to a geographic region that we are not as prominent in as, for example, in North America. So that helps with the diversification of our overall portfolio, in addition to this being a private credit or private lending strategy. Open it up again for any other questions, concerns, comments here.
Yes, Thomas, question, Jim Edwards here. Is this revenue then derived from the interest that's charged on these loans? Is that how they make their money?
That is correct, yes.
So, I mean, looks like it's a usurious interest rate.
Oh yeah, I mean, that's similar to...
And there's a problem?
Okay,
This is kind of like baby lending, huh?
Certainly is not your 2.5% mortgage that we currently can get in this country. Yes.
Thomas, are you concerned about it being headquartered in Hong Kong?
So that topic obviously came up given the current situation unfolding with China and Hong Kong. OCP does have a second office, I believe, in Singapore. The team has discussed internally, there are no current plans to move the office. However, they certainly have the ability to do so and are well aware of the unfolding events in China and Hong Kong, and certainly have the ability to do so. There's another opportunity. I believe a lot of the team has roots in Sydney, Australia, so they could open a secondary office there as well. So there are alternatives. They're talking about it. They have talked about it. If it happens, maybe in the next couple of years, 5 years. I don't know, Michael, if you wanted to add some comments there.
Yeah, so we've had the conversation directly with the OCP team. It's something that they are thinking strategically about. Probably nothing in the short term. By that, I mean within the year, but they are considering their options. I think the impact on the day-to-day business is less impactful They're really on planes and traveling to all the Asian countries anyways. They essentially have 3 offices now, informally in Australia, and then Singapore and Hong Kong. We visited them in Hong Kong and Singapore. So I think it's a fairly easy shift if they need to move out of Hong Kong. China is an exposure they've been looking at for a long time, but they haven't done any deals there. And so, I think with where their deal flow is, they are considering the option of moving out of Hong Kong. But it's a wait and see kind of situation. I think it depends more on the people and the team and what they want to do rather than the day-to-day business is what they've communicated to us.
Bruce?
Yeah, question, Michael, just a little bit more on that. You said that they think at this point that it would be fairly easy for them to disengage from the headquarters in Hong Kong. Could that get more complicated here? In other words, is there any kind of legal relationship that they have under Hong Kong laws that could be hard to disengage from or more problematic to disengage from? I'm asking you to speculate, but a lot happened just in the last couple months there, literally.
So I would say as far as moving the office, that's less of an issue as far as the brick and mortar goes. As far as some of their Southeast Asia deals, not China specific, but those deals being completed and papered in Hong Kong and having those move, I think that would be a bit more of a hurdle.
Yeah, and I guess that's what I'm getting at, is because I assume their paperwork is being done under the auspices of Hong Kong laws. That seems to me to potentially be a more problematic part than simply moving the people and, where they work out of.
Yeah, I think that's the case, something they're aware of. I'm not sure of what percentage of their deals are legally held in Hong Kong as opposed to Singapore or Australia. I'm imagining it's a fairly balanced amount, but it's certainly something that they're aware of and considering. It hasn't been, a red flag concern for them now. I think everyone in Asia is kind of thinking about how this plays out. It seems like the legal structure is still held in place. It's more of a social issue with China pushing on Hong Kong right now. But I don't know how fast or if that escalates into the legal and business realm. But something that, our managers are certainly watching for.
Thanks, Michael.
Welcome.
Thanks, Thomas.
You're welcome.
I have an easy question, I think, and that is looking at the management fee, 1%, 2% drawn. Can you explain that, the difference between the 1% and the 2%, or 1% committed, 2% drawn, please?
Sure. So you're making the commitment of $50 million, and then as soon as the investment period kicks off, OCP will charge 1% on that committed capital, that $50 million. As they draw down the capital, for example, they issue a capital call to us over a couple $1 million and invest that capital, that will be charged with a 2% management fee.
So why are we paying them while we're holding the money?
Very good question. I wish it wasn't the case. A lot of times we see that in this industry, in private equity, private markets investments, that managers charge on the commitment itself. Certainly a topic that limited partners like us will always bring up. We would much rather see a management fee charged only on the invested capital. I don't know, Michael, do you have another background why OCP specifically does it?
Yeah, for OCP, I think that's them giving up some of their fees. Most of our private equity funds do charge on committed. It's a remnant of the asset class and the strategy.
Yeah.
And so OCP views themselves as probably a mix between private equity and, more traditional banking debt. And so that's why they have kind of this hybrid model where it's not just invested fees, but it's committed and then switches to invested amount. So it's kind of a happy medium between the two.
What percentage of all our private equity does have that fee on the commitment?
Don't know top of my head, so certainly something we can look into. But yeah, very good question.
Certainly a heavy majority.
Majority, I would say, yes.
Yeah.
Is that changing over time?
On the buyout side, more traditional PE, that's not changing. I'm not sure if we have any buyout managers that are charging on invested. That maybe we'd have to look into that, but it's really the mass majority of private equity is charging on committed. It's a little bit different on the private debt side. Some of those and our managers are charging on invested, but really on the traditional private equity side, it's on committed.
This is Jim. I just wanted to say that over the years, I've heard the argument, and Michael will probably recognize this from private equity managers, besides the point that the best ones can charge it, is that it's a fee essentially that goes to the costs of searching for places to invest the money prior to it being called down from the limited partners like Montana. I'm sure you probably heard that as well, Michael.
It is. It's something, that we push on all of our GPs. We push pretty hard on management fees to know where it goes, that it's a reasonable size for the business. For a fund that has a $20 billion fund, they really don't need 2% committed fees to keep the lights on, right? For a smaller fund, it seems to make sense. Sometimes we will ask for, their P&L, their balance sheet to really understand what their payroll is like, to make sure that it's reasonable for their ongoing expenses. But in the grand scheme of things within private equity, the bulk of their profits is going to come in this carried interest format and not from management fees. And, we've done some modeling and seen the fees. It's, where the mass majority of their interest lies is in performance and carried interest, and not so much on the management fee. The management fee is really designed for, the ongoing business, keeping the lights on, the payroll, just ongoing business operations, and less tied to performance.
Oh, there you go. And Michael had some issues with his connection. I don't know if that's happening again, but to his point, yes, it's really focused on the business operations side, and then the bulk will come from the carried interest.
Thomas, I have a question about a two-question question. One is the top of the sheet talks about private equity asset class, yet this is not an equity investment unless you guys get participation in some of the direct lending. So that's question one. Is there participation on the debt side? And then secondly, when we look at our private equity asset class in general, how much of that is in essence fixed income versus equity?
Good question, Jim. Thanks for that. The first question, I almost want to defer that to John Putnam. Currently, we are lumping all direct or all private credit, private debt investments into the same bucket as private equity. Believe ultimately the goal here is to break that apart and have that as a separate composite once we reach critical mass with private credit investments. To the second point, it makes up about 12, 13% of the private equity or private investments bucket, I should say, which is fixed income type private debt investments.
And so with this manager in particular, is this all straight debt, or do we have any participating features with the debt?
This is all straight debt. Yeah, there's no participating stuff.
Okay, thank you.
You're welcome.
So Jim, to your point, we should probably change the header here because really we have the private investments asset class at this point. But we have talked about internally an intention to probably not report up directly, but we don't really at the moment have a separate bucket, if you will, inside of private investments to break out private equity and private debt. I mean, we know which managers are which, and so we can do that, but I think we'll probably sort of create that structure underneath because it's been a focus of ours to add to the private debt portion of the portfolio for some of the reasons that we've kind of talked about here, and that we would get more of that coupon clipping, steady income type stream as opposed to taking more of the pure equity risk. And there's some attractive opportunities here. OCP is a perfect example, really, where we do get. As Jim asked about, Jim Edwards, it's a fairly high rate, and the reasoning being essentially that these are smaller businesses, they're privately held. In Asia, things work a little bit differently. There's a premium put on kind of the privacy aspect of OCP. They have really great relationships with a lot of the kind of wealthy private families who would hold a lot of these businesses, and they value the aspect that they don't have to go to a bank or a more public institution and I guess, if you will, air their dirty laundry, or if you want to call it that, but they certainly value that relationship. And so there's kind of a reason why there's a premium associated with a lot of these deals, relative to perhaps what you might see in the US. Anyways, so I'll leave it there.
Anything else for these guys? If not, thank you.
You're welcome. Thank you very much.
So we'll move on to one of my favorite people to pick on, John Ramosko.
Mine too.
It's just a talent he has.
Yes.
So John, hopefully you're here, and Kirsten, I promise I won't pick on you.
Thank you, Mr. Chairman. I would refer you to tab 9, page 234 on what I'm looking at, but yeah, I think the only thing behind tab 9. A couple of policy changes that we're asking for. The first one regarding STIP, we would like to participate in a CD program that the FDIC sponsors. It was not clear in the language of STIP that was allowed. We wanted to just make sure that we cleaned up the language to make sure it's allowed for us to participate in an FDIC insured deposit account without a rating. Any questions on that?
Yeah, Mr. Chairman, John, I've got a question. What is, I think I've heard of this, but I don't know for sure, NRSRO rating?
Nationally recognized rating service organization. Did I get that right, Putnam?
Statistical rating organization.
Statistical rating organization. So that's S&P, Fitch, Moody's, De Beers, and a few others. But we just want to make it clear. We wanted to make it clear, Bruce, that, what we wanted to do was not reference S&P, because referencing S&P directly in any of our policy statements was going to cost us $25,000. So that's why the little bit torturous language there.
Okay, thank you.
Any other questions on the STIP policy language? And seeing that, I'm sorry, go ahead.
I was just, do you need an actual motion or is this a more notification?
We need a notification.
And
This
a
is
motion?
this require, in my mind, deferring to Dan, this requires a motion because it is a change to the policy statement.
Okay, so,
Mr. Chairman, I would make that motion that we accept the changes as proposed.
okay, is there a second?
Second, Harry.
Okay, so moved and seconded. Any other questions? If not, all in favor, say aye. Aye. Any opposed, same sign. Hearing none, motion passes unanimously.
Thank
Okay,
you.
John.
Going on to the next item, new account. It's actually the DNRC is responsible for this account, but the funds are all spent, will all be spent by Fish and Game. 2015 legislature set up a trust for invasive species, the proceeds of which will be used on aquatic invasive species. So we expect this to be a permanent fund with almost all funds invested in the trust fund investment pool. Any questions or concerns, comments with that?
So I have a question.
Go ahead.
So John, it says deposits may not be appropriated until the balance reaches 100 million. So they will be able to take the earnings, but any of the principal won't be used until it hits that 100 million. Is that correct?
My understanding.
That's correct. It honestly is unclear whether the earnings will be expended or if they will build up in the principal, like we've seen with some other funds. It wasn't clear in the code that was the case. So we did not state that the earnings will remain in the fund until it reaches the 100 million.
It does say here that the earnings will go to an account managed by Fish, Wildlife, and Parks to fund projects. So that means it won't stay in the fund, in my mind. Is that correct? I just want to make sure I understand, John.
Yeah, so I'm sorry I'm hemming and hawing a little bit, Maggie. The answer is it's unclear both to us and to the Fish, Wildlife, and Parks and DNRC if that means before it reaches 100 million or after it reaches 100 million.
Okay, I see. I understand now. Thank you.
And so we don't think of that as something that would change the investment policy or the guidelines.
Yeah, it would change it in my mind, I guess. I'm going to make the assumption in my mind that the earnings won't be distributed until it reaches 100 million. I don't know. It does make a difference to me. So.
Yeah, so in terms of investing the money, we still would assume that we're going to put the large majority, almost all of it, in the trust fund investment pool.
Okay.
John, how close is it to 100 million?
It's a little more than 98 million away. So it was, last I looked, slightly under 2 million. So sorry, Maggie, maybe I should have called that out to begin with.
All right, with that kind of answer, I guess we call for a motion to approve this. So would somebody like to make that motion?
I'll make the motion.
Edwards has made the motion. Is there a second?
Second, Jeff Greenfield.
Thank you, Jeff. Moved and seconded. Any discussion or questions? If not, all in favor, say aye. Aye.
Aye.
Any opposed, same sign. Hearing none, motion passes unanimously. John, is there anything else in this section here that we need to talk about?
Nothing for us, Mr. Chairman. Thank you.
Okay. Any questions for these guys? If not, we'll move on to tab 10, the investment update. And this will be easy. I'll just turn everything over to John.
All right, thank you, Mr. Chairman. So under tab 10, I'm on slide 4, CIO update, retirement plan performance. On this particular slide, just showing the difference between what we made and the net cash need over the course of 1, 5, and 10 years. And perhaps the most impressive thing, I guess, given where we sat last quarter, is that, we came pretty close to essentially breaking even, I guess, if you will, from a net asset value over the course of the last fiscal year here. And so anyways, a good rebound in the second quarter, as we've sort of talked about, and no huge surprise, although I'm noticing on my slide, which I just noticed, it still says 331.19 and 331.20 at the bottom of those, which isn't accurate, but the numbers are accurate. I don't know if it says
Is it
that.
June 30th then?
It's June 30th. Yeah, apologies. I did not see that prior. If we go to slide 5, we see essentially the same thing here, but broken down by the asset classes. A few things I guess I would point out, probably looks like less activity than it actually was in terms of overall net cash flow over the course of the year. But as you know, quite a bit of activity, particularly in the first 6 months of 2020. Domestic equity in particular, we added a substantial amount to that, about 170 million in the first quarter. And then we subsequently took out about 110 million closer towards the end of the second quarter as markets rebounded strongly. Core fixed income, obviously you see a fairly large drawdown there. It's even a little larger if we're just kind of looking at the last 6 months. We took out just a little less than 600 million as we were funding our operations or our net cash needs, certainly in the first quarter. And then in addition, it probably taken some more reallocate to other parts of the portfolio that have more attractive returns at this point. Maybe a little bit further down, cash equivalents and pension STIP. As you know, we took a fair amount out of the cash asset classes broadly as we brought that down. That happened probably more towards the end of 2019, maybe the early portion of 2020, and then we probably started building that back a little bit here more recently. Any questions in particular about changes there? All right, seeing none. Tab 6, slide 6. This is just the same numbers once again, just broken down by the pension plan. You can see that some slight differences there, but nothing really major to note, I wouldn't say, on this slide. On slide 7, we've got our overall performance net of fees. 1-year performance in particular here, 2.7%. Not sure a year ago I would have said 2.7% was something that we should be really excited about, but after the first quarter, I don't know, I think a positive result here was pretty good news overall. And certainly in our longer term numbers, maybe most importantly since inception, still pretty close to our actuarial hurdle of 7.5 or 7 5/8. So doing reasonably well there given recent circumstances. Slide 8, just a typical quilt chart that you've seen many times before. This is just with our particular benchmarks shown here. Slide 9 gives the returns for the individual asset classes. Once again, I think if we were looking last quarter, virtually all of these were red, with the exception of core fixed income, if I recall, maybe cash very slightly. We have certainly recovered substantially from that. International equity still down a bit. Natural resources substantially more. That was driven largely by, I would say, our MLP exposure there, which took a pretty big hit.
So that's a big hit. I know we don't do things except in the long term. But is that a red flag, natural resources?
Well, I think there's certainly been a recognition, and we talked about it a little bit yesterday within, say, high yield, that the energy sector is changing substantially. And there has been, I mean, Ethan can talk about it a little bit more when he gets to his section, but there's certainly, I think, a recognition across the industry that results within kind of oil and gas energy have not been good. And there's a shift away from that, and I don't think it's a short-term shift. There's a secular trend moving towards more renewable sources of energy, but it's not like that's going to happen overnight. So we recognize that. So it is a long-term concern, and I think a long-term shift that you will see both us and others start to make. I don't think it means that we're going to completely exit, oil and gas by any means, because that will still be with us for a substantial amount of time. But there will be changes, I think, incrementally as we move along in the portfolio. Good. Slide 10 just shows our.
John?
Yes, sir.
Yeah, I've got a question, and I don't know whether now's a good time to talk about it or when Randy is up, but I'll throw it out now and you can respond whenever you think's appropriate. There's a lot of talk right now about the domestic equity stock market and how it's being driven right now by the tech stocks. You look at, the movement is primarily apparently attributable to the Microsofts and the Amazons and the Googles and Facebooks, but the broader market, isn't necessarily reflecting that. So I guess kind of two parts to what I'm looking at here is that the case? I think it is because of all the news reporting. More importantly, what is the significance of that? And the next part of that is there greater risk or less risk or greater opportunity or less opportunity if in fact that's the case in the market right now? Again, John, I'll leave it to you as to whether you want to talk about that now or later, but there's a lot of news reporting out there about it right now.
Absolutely. So I'll give you a few thoughts, and then I'll let Randy give you a few more when he gets to his section. Try not to steal his thunder too much. But you're right. It's been a very narrow market. So the FANG stocks, if you will, have been performing extremely well. It is a concern of ours. We have certainly noted that, and we've, as I noted, some of the money that we have taken off the table within equities, both, towards the end of the second quarter and continuing kind of into the third quarter here, we probably have leaned towards taking, a good chunk off and say the large cap, the S&P 500 type names, because we're not, as we've got a lot of passive. So we're not necessarily, it's not as if we've got, Netflix or Amazon or something as an individual holding for us that we can directly take off. So we're cognizant that, say the large caps have done extremely well. So we've lightened that up, brought it down a little bit within our overall portfolio. One of the reasons, and we talked about this kind of last go round when we talked about, well, should we have active managers within our overall portfolio? I would say part of our underperformance that we've seen more recently within domestic equities is attributable to the fact that we don't necessarily hold some of our active managers, large weights in these very large cap stocks. And I'm okay with that, because I think we feel like we should probably start to lean away from that a little bit. Sometimes I think, we tend to look at performance more broadly Did we outperform or underperform the benchmark? But I think we also have to think about the risk that we're taking. And as you noted, if the market's becoming very concentrated in those stocks, you know, from a risk management perspective, if we have active managers that are going to lean away from that a little bit or give us maybe some of that value bent that has been out of favor for a long time, I mean, that might be an okay place to be. And we, you know, we have to start to ask ourselves, are we comfortable at some point being all in, if you will, on something like that? So, I mean, it's a difficult question in a way. Nobody's really got the right answer. Can some of these things continue to run? I don't know. You know, we're typically not real great at forecasting, but I think, you know, the typical bias that we would have here within all of our asset classes is when we see certain things becoming expensive, we would like to modify the portfolio a bit and start to lean away from things like that, or vice versa. As we see things get cheap, that's probably an area that we want to go to. And sometimes those things can be difficult decisions and painful decisions at the time, but, you know, got to kind of keep with our broad philosophy and do what we think is right. So maybe I'll leave it there for the moment, if that's okay, and Randy can certainly jump in when he gets to his section.
Yeah. So, you know, when we look on page 8, you know, it looks like, you know, pretty clearly natural resources wins the ugly baby contest. I mean, they're for the 1, 5, 10, 15 year, they're.
Is that a technical investing term? Should we put that in our notes?
That's the term.
Can't do the acronym.
But I mean, what's our midpoint of, you know, where we want to be in that asset class? Do you know offhand?
4%.
Yeah, 4%.
4% is our midpoint right now, yes. So 1 to 7 is the range. And we are currently at 3%.
Yeah, so
we're a little below our midpoint.
So this is just, you know, my mind spinning, but it seems like when we do the reallocation thing that we do kind of once a year, it would seem like you'd want to address this one because it just looks like we're diversified, but the less we're in here, the better off we're going to be.
Where's the time to buy?
Huh?
Yeah, so there's, you know, I mean, to Jack's point, and I don't want to get too far into the weeds, but, you know, some of the distressed debt stuff that we talked about with Golden Tree and we saw in high yield, I mean, there can be opportunities in those areas. We think distressed debt overall is probably a good time. That's why we added to Golden Tree. So there can be opportunities within that carnage, and, you know, it's a balancing act, I guess.
It's your crystal ball is what it is. It hasn't worked well for 10 years, so the last 10.
Right.
Can you, just for me, you said MLP is part of the reason we're low on natural resources. What's MLP?
MLPs are
It's not the master limited partnerships?
but what
Okay.
they really are is the pipelines.
Okay.
They're the pipelines.
Okay, that's what I wanted to make sure I
Yeah.
understood. Because I knew what MLP stood for, but then I was trying to,
Yes.
how does it relate? So
Sorry. Yeah.
so it's the pipeline.
Investment speak stuff. Too many acronyms.
Yeah.
Okay, so slide 10, I don't have a lot to say here other than we're in our ranges, have never been outside of our ranges here. You know, we've really crept up in domestic equity and international equity. We're a little above, you know, kind of above the midpoint. That has largely been market driven. As I said, we've kind of trimmed there a little bit here and there to keep that at a reasonable level. Quite honestly, at some point, you know, we run into the issue of, okay, well, we could sell some domestic equities, but where do we put it? Core fixed income doesn't look particularly attractive at 1% yields, which is where you might normally have kind of hit out, if you will. You know, we've brought cash up a little further than you see here. You know, but there's kind of limited, we can't go and as you know, force a bunch of money into private investments or real estate or something because you just can't get that money to work real quickly in some areas.
But John, isn't that, I mean, why we have the ranges? Because the midpoint is target. But the ranges give you some flexibility to say, geez, this is not a good time right now to bring it down, right?
All I'm saying is that to, you know, Bruce's point, things look expensive, let's say in domestic equity, but at some point it's difficult to, yes, I mean, that's why we have those ranges. But sometimes the market's forcing you into areas and you can't necessarily, we will reallocate the best we can, but there's limited things you can do within, say, privates in particular. And if other areas don't look attractive, then, what do? It's a decision every day that you make. Not trying to offload it on anybody else, just pointing out the obvious here, I guess. So with that, no questions there. I'll move on to slide 11, our macro attribution. So Aaron does this for me, for us. And I asked him this go round to do it for the first half of 2020 so that we could take some of the noise out of the steep drop and the steep rebound. So at least we get a little less noise than we saw when we were just looking at the first quarter last go round. As we get more data here, you'll recall we kind of put this midpoint structure in late last year. So as we get to the point where we actually have a year's worth track record, we'll start doing it for a year as opposed to quarterly, because I think it reduces a bit of the noise. So strategic asset allocation, if you kind of look at slide 12, I guess that shows you, kind of the quick hit of what went up and what went down. But essentially, if we were to have been invested throughout the quarter at our midpoints, we would have earned a return of negative 4.3%, largely driven, of course, by the equity asset classes. Now, remember, when we're looking at this, when we talk about equity asset classes, we're looking at our benchmarks. So that includes, for instance, the private investments benchmark is a small cap equity benchmark. So if we were invested in our benchmarks, throughout the quarter, that's what we would have earned. Tactical asset allocation, our actual weights, on average, we were a little overweight core fixed income, underweight some of the private asset classes. And again, we talk about this as tactical asset allocation, which sort of implies that we made active decisions to move the portfolio tactically. That is true in the context that, we were perhaps buying or selling public equity asset classes or trimming within fixed income, as I mentioned before. Certainly less true in the context of, private investment. Midpoints went up because the overall portfolio went down, and, by virtue of them not dropping as much, they may have gotten higher or more towards their midpoint. It's not really an active decision on our point. It was just the broader market move and the denominator change of the overall portfolio. So it's kind of a blend here, but I think it's still valuable information. In aggregate, would suggest that we added a little bit of value, at least to the portfolio, over the course of the first half of the year. In terms of style selection, so, kind of what are we invested in within the individual asset classes? Our small cap bias in domestic equity was a slight contributor to underperformance because, as we talked about, the performance in domestic equities has been driven largely by a handful of those large cap tech names. Exposure to our international growth indices on the other side of the ledger was kind of an offset to that, where we did add a little bit of value there. And then manager selection, the last thing. So again, not really a lot to say. Domestic and international were kind of offsets to each other in terms of manager performance. So broadly a wash within the public markets. A slight advantage here within our internal core fixed income and our one external manager, Reams, who did quite well over this time frame. Non-core, which has really been our high yield managers, pretty much a wash, but driven largely again by our private assets, which of course we've got that lagged effect. They're not moving in the same fashion as the public equity markets. And so, a big outperformance driver here. Real estate in particular is kind of a standout if you look at the details in terms of manager selection. And as I mentioned yesterday, throughout the course of this quarter, still benchmarking ourselves to the MSCI US REIT index, because we couldn't really make that shift intra-quarter. Once we moved to the ODCE, I think some of that noise will get to be a little bit less. So the MSCI index did much worse than what our internal managers did. Questions about the attribution pages here? All right, seeing none, slide 14. Some of these things we've talked about a bit, but just a few bullet points, quick update. So asset allocation discussion, as we've mentioned, we will bring a proposal to you in October. You'll have time to consider that and then make a decision in November. Cabinet's meeting next week to discuss our asset allocation internally as to what we think we want to do. We've got meeting set up with RVK in mid-September to get their thoughts on things and walk it through. So more to come there. Proxy voting, Dan Zarling's taking a look at our proxy voting process right now, kind of the way we do it currently. There'll be a presentation in October. I suspect we'll have a few changes that we might make there. Just something that's coming up for October. We've talked about the due diligence process a bit. So, I mean, it's an ongoing discussion with COVID. We'll continue to be, we've made our views clear that we still think we want to do our process, our on-site stuff to the best of our ability. The longer it goes on, the more difficult that becomes, and we'll come back to you if anything changes. But, it's an ongoing discussion with all the staff. We'll continue to do the best we can and do what's right. We're not going to make anybody travel that isn't comfortable with it, but we'll find ways to move forward the best we can. Search for investments, it's interesting because we have had such a fast rebound. There aren't as many, I guess, attractive opportunities as there were in March. You were looking at a sea of things that looked like they had a lot of value. That has reverted, and now you're starting to look at things and say, man, things are looking pretty expensive. So, but there are still pockets of the market that are attractive. I think distressed debt is probably a good example where there's still things to come there. Certainly, we've talked about non-core, looking for other places to find some both diversification and some yield in contrast to core fixed income, what it offers at the moment. So we'll continue to look there. Continuing rebalance of trust fund and state fund, just related to our, as you know, kind of shift towards more real estate and more non-core within trust fund. We've added high yield into state fund. So we've got an initial investment there that we got started in the second quarter. Moved to the aggregate benchmarking state fund, so more mortgages there. That'll be a slow process, multi-quarter, probably multi-year for both of those portfolios, but we've definitely been making progress, and it's kind of top of mind as we look at those portfolios. COO search Dan's talked about. I won't spend any time there. Last item, I guess, is just wanted to note that, RVK board member education is on the docket for the October meeting. Curious if there's anything that the board would specifically want to talk about. I might suggest that perhaps infrastructure / real assets might be a good area to have some education about, but entirely your call as to what you want to hear about.
So for me, it's always the new things we're looking at, so new asset classes. So the one that you suggested would be great, but it could even be a little more broad in some of the other asset classes we're looking to deploy funds in that we haven't deployed in the past, would be what I'd look for.
Okay.
Any others who want to learn something?
Nope, they don't want to learn anything.
They don't want to learn anything.
We just want to know which assets will do best.
Yes, that would be nice to know. We'll put Jim in charge of that.
Okay.
Be prepared, Jim.
Sounds good. We'll discuss then with RVK and think about things that are coming up and try to come up with something. Maybe send out an email to everybody before we come up with final topics or anything so you can take a look. And that's everything for me. So I will turn it over to Dan Zarling to talk about risk management.
Good morning. I hope everyone can hear me and see me.
Yep.
Good. Thank you for having me present when the equity markets are at their all-time highs and valuations are reaching for the stars and are near dot-com levels. So I want to start on slide 2267, or I guess 15. I show these slides so that just to highlight how unusual this COVID recession is. And what I mean by that is personal income has gone up over 10%. At the same time, the economy has dropped 9.5% in the quarter. Personal expenditures also dropped, so the savings rate went way up. And then at the same time, we have, on the next slide, I'm just showing that unemployment is still unusually high. It's over 10% still. And we have over 16 million on unemployment claims. So suffice to say, there's a lot of workers that are idle. And the only way this can happen is that there were stimulus checks and PPP, which all provided a temporary relief for this lockdown. And it's a good reminder that, the government put together their fiscal response, and it was around 2.4 trillion, or over 11% of our GDP. I don't know what to make of this, other than I'll just say that there's been commentators to say that the current economy has been compared to a natural disaster rather than a full-blown recession. And I think that's a good analogy. Hurricane forecasters, when they talk about the path of a hurricane, they discuss it as the cone of uncertainty, and I really do think that applies to the economy. I think that we put in the lows, and the recent data has shown that the economy has picked up, and I think that's what the stock market has certainly picked up on. But really, forecasting the economy is really like forecasting the weather right now. And just want to throw that out there and say to Jim Voitko that I got your back, and you can run with my analogy if you care. On my next slide, where I'm going with this is to explain a little bit that with the monetary flood into the system, it jumped the money supply, M2 money supply, which you can track on a monthly basis. That went up 25%. And when you compare that to the great financial crisis, this was in magnitude, this was far bigger, and it's a very fast response. And I think that's what's supporting the markets right now. It's certainly providing a floor for the market. And at the same time, there's a government response here. And of course, they're spending money that we don't have. So it creates a federal deficit over 800 billion. And again, that's just in the last quarter. There's a fiscal spend of something like 5.5 trillion, and we're not even over with the fiscal year yet. So, that's, again, it's suffice to say that at high debt levels, I think, is one of the takeaways from this lockdown, and that the government is, at least the federal government, is reaching a certain threshold of, how much debt they can take on It's going to basically approach 100% of GDP, and the current deficit for the fiscal year will be coming in around 18% of GDP. And so I don't think there's a lot of capacity for additional debt in the U.S., and it's something that's going to have to be addressed with taxes or something. But it does indicate to me that this will be a drag on future growth. The other point I want to make on this slide is a red line, which is CPI or inflation. Inflation really hasn't moved that much. It did jump up in July. That was, and treasuries did react to that. What's interesting there is that we're in negative real interest rates, and that's going to be the case for the foreseeable future. So I think that this is a no-brainer that we're going to get higher inflation in the future. And it's so much so that the Federal Reserve Chairman, Powell, is quoted as not even thinking about raising interest rates. Now, that's an astonishing quote from a Fed chairman who previously tried to normalize interest rates. And I think that the Fed is formally going to come out changing their views on how they target inflation, so that they're going to work with a symmetric average and allow inflation to go above 2% rather than automatically trying to keep it at a static 2% by raising rates. So I wouldn't be surprised to see inflation at 4% before the Fed even reacts. But there are other deflationary forces that tell me that this is not on the immediate horizon, and that I don't think that we're going to have runaway inflation. It's just a heads up that things are changing here, such that longer term, 10 years or longer, I think that we're going to see higher inflation. And that's where I want to kind of just reiterate that longer term, I think we're going to see a continuation of negative real interest rates. We're going to see more government debt and a larger participation of the government in our economy. There's going to be less globalization, or more protection, higher tariffs, so there's going to be less global trade. And all of that is going to translate into lower corporate profit margins. And these are just some of the things that, we may need to talk about when we are discussing any changes to our asset allocation, for the long term. So with that, I could go on and on about kind of COVID implications, but I just wanted to keep it kind of short and brief. But are there any questions on these economic indicators? Okay, then I'm going to go on to valuations. I'm on slide 18. And so this is the valuation. I wish it was a little bit more presented on a historical, graphical basis, but I'm trying to summarize where our valuations are with our major asset class benchmarks. And it doesn't fully tell the picture in terms of when you look under the hood, there's a wide dispersion of valuations. But it does indicate that valuations are high, and this is already outdated as of 6/30, and so I can safely say that all of these valuations have been moving up since then. I do want to point out that the cap rates that I have on slide 18, those are a little outdated, and it's because it's coming from Real Analytics, and it's kind of quarterly data from basically private real estate transactions. What I need now is kind of more real-time numbers, and so that will be updated on a more frequent basis. And so when I look at the implied cap rate on REITs, I get a very different picture when you look at these different property types. And by that, I mean the retail REITs, you know, their cap rates have gone, say, north of 8%. So there's a definite feeling that retail malls are in trouble, whereas industrial REITs, their cap rates have dropped anywhere from 5 to 4%. And of course, that means that it's a higher valuation when you have a lower cap rate. So there's a lot of enthusiasm with industrial distribution. And again, that's all tied to online sales and the lack of retail. So those are just some of the dispersions in valuations that I wanted to point out. And that's also occurring in the equity markets, and it also happens in the fixed income markets as well. The spreads in the fixed income market are fairly tight now, and it's suffice to say that, again, as Jason was talking about high yield yesterday, the default rates for high yield is at 6%. It's expected to go higher. It may go as high as 12%. And most of that is concentrated in the cyclical industries such as energy. So again, there's a lot of analysis going on and trying to discern what that all means. But it's suffice to say that there's going to be, we haven't seen all the bankruptcies yet. It's just been a delayed response owing to the certain circumstance. And then, of course, I don't need to talk about treasuries. They're at the all-time low. That means that treasuries no longer become an effective hedge for additional economic dislocations in the future. If there's one valuation chart I wish I had, and that would be on gold prices, but of course I can't because there's no intrinsic value to gold, so it's difficult to put a valuation parameter on it. But gold prices are certainly at record levels right now. I want to just pause there before I jump into liquidity. Are there any questions about valuations right now? Okay.
I can ask questions.
Yeah.
So I'm going to jump to slide 20, and this is my liquidity dashboard, if you want to say. There's no material change here. I just want to highlight that this is, I can update this on a daily basis. It's real time. So when Thomas talks about these additional private equity managers that we sign up, I don't need to wait for State Street to put it on their reports, which is about 3 to 6 months behind. I can add it to my spreadsheet right away and see how that's going to impact our use of cash. And so the numbers you see here include all of our recent commitments to the new private equity managers, and it would be the same thing for all our other private classes, private asset classes such as real estate and natural resources. And I want to point out too that the inputs can be changed. So I'm just assuming that our capital can be called 25% in 1 year for the next 4 years. If I drop that number to 12.5%, then I can see what that will do to my liquidity. And it basically brings down our use of cash to about $730 million, and it means that our liquidity ratio then jumps to 20 months. The reason I bring this up is that with the high valuations in private equity, acquisition multiples right now at about 14 times, I don't think that private equity will be calling capital at a faster rate than what I'm assuming here. And in fact, private equity may take 8 years to call down capital. I don't know. But this is just to highlight that I can make changes very quickly to as we add managers. Any comments there? Okay, so I have my geographic exposure. I don't know if I don't really have any comments there unless people want to talk about it. It just highlights that we are very North American centric, and that's basically where all our risk is coming from, which is growth equity in the U.S. My other page is about concentration. I do want to comment about our top 10 issuers. I think if you look at this list, aside from treasuries, liquid securities that are at about 12%, if you notice the next 5 names, hopefully they look familiar. These are the FANG stocks. This is what the media is picking up on. And yes, these 5 stocks, and you might want to throw in something like Netflix. I don't think that belongs in this group, but these big tech names certainly are a greater concentration in the indexes than we've seen in a long time. And when you look at this, I look at this and say, well, maybe this group, because it's acting so similar, their correlations are essentially 1, that we should be paying attention to them as a group rather than, individual securities. And so when you add up these 5 names, I can do that in the data, and it works out to be about 650 million. It's about 5.5% of our portfolio. And then for context, when I look at these names in the MSCI USA IMI, which is a benchmark with thousands of securities, these same top names are about 19.9% of the index. But things are fairly concentrated because, at about 650 million, that's almost as much as, in fact, that's more than what we have in emerging markets at 3.9%. And it is just under what we have in 2 130/30 managers, which is at about 6.3%. So this is a fair amount of concentration. It indicates to me that we have momentum stocks in the pension portfolio that has benefited us. If these 5 stocks decline in value, we're gonna feel it in the portfolio. And I would challenge RVK on this to say, do we have a value bent in our portfolio, or what exactly is it? Because when I look at these top names, I don't see a lot of value. I see more of the large cap tech. And that's exactly what's been working for us. Let's see, I'm going to stop there, and I just want to clarify that, we do have a 5% limit. That's about 590 million. This isn't, these numbers are not approaching that, and that we have a 2% limit for private equity funds. That works out to be about 230 million. And no, we're not close to that either. But if you want to think of these 5 stocks as its own portfolio, then it is fairly large, and it's it actually makes up more than 35% of our overall tech exposure in the pension portfolio, which is about 1.8 billion is my last calculation on that. So with that, are there any questions so far?
Okay. All right. So chairman's prerogative here is because Maggie went and got coffee and Cookie, I think we might want to just take a short little break so we can keep up with her. So let's just take a little break here, keep our concentration good, and we'll start back at 10 o'clock. How's that?
It's good.
Back to our meeting. And again, John, I'll turn it over to you to introduce people.
All right, I think Michael's up next for private investments on slide 24.
Hi, everyone. I'll talk about private investments in the market environment. I would say Q1 was fairly muted. We're starting to see numbers come in for Q2. It's, as expected, as RVK and our team has mentioned before, there's some private investments lag, but Q2 was certainly impacted. We're seeing deal volume and values come down, 43% reduction in volume from kind of a rolling average. That's what we're seeing in our portfolio as well. I would say that most of our managers have put their deals either on the buy or sell on hold and are waiting to see where things stabilize out at. The deals that are getting done in market have been larger and mega cap type deals that have been consummating for quite some time. I think that's what's driving the second and third bullet point. You're seeing high valuations, high leverage. I think the largest companies and quality companies, those deals are still being done, but really the deals at the lower and mid end of the market are being put on hold for Q3, Q4, and that's what we've been discussing with our managers. Dry powder still remains at record highs. Lots of dry powder capital on the sidelines waiting for deals to get done. Hopefully we'll see valuations come down the back half of the year, maybe some repricing and some deals getting done within our managers. Fundraising, as expected, has certainly cooled off, maybe even dropped off. I think people are figuring out what to do, whether it's to continue their historical practices of due diligence or to move to a virtual model. I think it's a mixed bag. It seems like most of our peers have been in more of a wait and see type of status, similar to us. I think that makes sense for the larger
Uh-oh. I hope
Starting to
Michael.
lose you, Thomas.
Yeah,
What's
looks
your
like
tie out,
Michael dropped
Thomas?
off again. He's got some issues with his internet connection. Usually I blame myself for pirating on his Wi-Fi sitting outside of his house in my car. That's not the case today. I'll try to pick it up. He'll probably dial in quickly again. But as he mentioned, yeah, a lot of folks trying to figure out how to work around due diligence, fundraising on the GP side, and as well as due diligence on-site travel type situations for the LPs. John can speak to that as well, or has mentioned earlier. We're kind of in a waiting pattern here. We'll see how long this pandemic or travel restrictions really impact us. Interestingly, I would jump to the next page actually. Michael dialed in already. No, it doesn't look like it. On the return front performance page, the next page, really solid performance. Certainly felt some impact in the early 2Q numbers, but overall our portfolio has held up very well. We've seen a kind of a mixed bag where we have a handful of companies that got impacted pretty significantly by COVID shutdowns. For example, we have exposure to a dental clinic for children that got shut down for months on end. They're working through it. On the other hand, most of our GPs have portfolio companies that are actually benefiting very, very strongly from this COVID type environment. One example comes to mind. There's a portfolio company, Royal Paper. They producing and making a lot of paper products, i.e. toilet paper. And you're going to laugh that, yes, the toilet paper shortage apparently is over, but they've seen one of the best quarters ever with paper towels and toilet paper. And another one was doing plexiglass type manufacturing. So now every cashier in the country wants to have one.
Very good here.
So that certainly is kind of balancing out the overall portfolio. And as we saw in the quarterly numbers on the performance as well, it's not as a dramatic impact as we may have expected. Overall characteristics on the next page for the portfolio. I'm not sure what Michael had prepared here in terms of comments, but I'll walk you through that. We're at about $1.5 billion in overall private investments, continue to be North American centric, as you can see here. We continue to focus on direct fund exposures. We still have some older late 90s, early 2000s fund of fund exposures in here, adding up to about 18%. 12 or 13% of that is actually our Axiom exposure, which I spoke to earlier, and selectively continue to focus on sector specialists in venture as well as buyout. Credit, as John as well has spoken to, a big focus in the distressed space currently. So that's certainly an opportunity or an environment where we see a lot of opportunities. Overall cash flow slightly negative. I see Michael dialed back in. I don't know if you want to take over. I'm
Sure.
pretty much wrapping up with the recent 3 commitments, which we spoke to earlier. I don't know if there's any other follow-on questions to that.
Hi, everyone. Sorry about my connection. Of course, it drops off when I'm presenting. I just wanted to share a couple of things that are not on the slide. I think overall the portfolio is holding up pretty well, especially compared to overall market. We've always had a pretty conservative posture in the portfolio. Our buyout is focused on lower middle market and mid market. And so generally we've had lower leverage, lower multiples, valuation multiples in our portfolio. And so, that's held out in a positive way over the last couple of months. In our private debt portfolio, it's been historically bifurcated on both ends of the spectrum within credit. That's really senior loans. You haven't heard about us doing anything mezzanine or junior. And so we've been senior, top of the cap stack, and getting paid our interest. And so, our private debt portfolio has done pretty well. On the flip side of that, and some of the deals we've been working on that Thomas has talked about, Golden Tree, other distressed debt, that's been a great opportunity, a shining star in the portfolio. Performance there has been excellent. We've had some pretty interesting exposures that I want to share. Within our VC fund of funds portfolio, we've had some big exits within Zoom and Slack. Definitely 2 of the top performers in the public equities. We have exposure through VC and early stage private exposure. And so those have been major wins. A couple other headline names in the portfolio. Through our distressed debt managers, we have exposure to Hertz, Royal Caribbean, PG&E. We have exposure through the debt, the bond, the convertibles, the preferreds, the equities. This is exposure that we don't have in the rest of the portfolio to the same extent. And so our managers and our strategy is working. Outside of exposure, cash flow for the quarter, negative $48 million, that's as expected. I would say the capital calls have been on pace. Distributions have slowed for Q2. That's as expected. Not a lot of deals are getting done. You might ask why is our capital being called? I would say from our managers, it's really a defensive position. They're putting money to support existing portfolio companies. Haven't seen a lot of, but there is certainly some new deals being consummated, but predominantly focused on protecting the existing. I will pause there for any questions.
Okay.
All right. No questions. We'll move on to Ethan for real estate.
Morning, everyone. Can you all hear me okay?
Yes.
Yep.
Great. Well, nice to see everyone. I'm going to maybe mix it up a little bit and take a bit of a more unconventional approach here, given the unusual times, and rather than sort of reiterate some of these bullet points here, I'm just going to open it up to questions. I know there's got to be a lot going through everyone's minds as it relates to real estate. I've highlighted the usual suspects here, but I'd really prefer to have more of a conversation and attempt to do the best I can to answer any curious questions you all might have as it relates to what's happening in real estate. Certainly, there's a lot of uncertainty and unknowns right now, but if you have some questions, would love to share what I know and what I think.
So Ethan, I'm always concerned about problems. And so without maybe, naming names exactly or whatever in a public meeting, but can you give us an idea how your major concerns are on maybe percentages or just, I'm really worried that this is going to be a bad time for real estate in the next year or two.
Yeah, so it's a great question, Jack. And, I'd say relatively speaking, we're in pretty good shape. At least that's what I feel in my heart of hearts. Our hotel exposure, which is, as a sector property type, has been absolutely decimated and will likely take years to return to normal if that ever happens, frankly, depending on what the virus does. Is pretty de minimis. We've got less than 3% hotel exposure, so that's great, and most of it exists in our core funds, a smattering throughout our value add funds, but we've got very low hotel exposure, which gives me great confidence. As far as our retail exposure, which is another area that has been largely hit, I'm happy to say that while we do have some mall exposure in our core funds, most of our retail exposure, which I think is just north of about 13 or 14%, is in the form of grocery anchored infill retail, which has outperformed, has done exceedingly well and held up during this downturn, is needs based. And so that gives me great comfort. We've got great industrial exposure. We've got great industrial exposure, which we continue to look at and add to. Forgive me, I'm being bombarded by munchkins, but nevertheless, I will persevere.
What's their opinion on real estate?
So, I feel pretty good. As we've talked to our managers, rent collections across the board have been very strong, notwithstanding our hotel exposure, notwithstanding some of our retail exposure. I just got some numbers from one of our diversified value add managers who invests across office, retail, industrial, multifamily. And, for April, May, June, July, their rent collections were in the 90th percentiles. Our grocery anchored retail manager throughout the course of the downturn was in the high 80s and is now, I'm happy to say, collecting 100% of rents. So, generally speaking, rent collections have been super strong across the portfolio. Office, the one property type I haven't touched on, I was talking to John and the cabinet about this, I think earlier this week or last week. No, it must have been last week. I think that's a big question mark. I think that's got a longer tail as far as how that's going to play out, given the work from home versus come back to the office equation. And that, that's a big TBD. Notwithstanding that, our office rents have been good, but we'll see how that pans out. So, the problems are there. I'm not going to shy away from that. The cycle is turning. we've seen prices correct in various markets. Vacancies are going up, for example, in Manhattan, as there's an exodus of people leaving Manhattan to, either, permanently move to a suburban environment, for example. So vacancies are going up in multifamily in Manhattan. Rents are adjusting, and that's going to happen depending on what market or property type you look at. There's going to be extreme or moderate variations depending on the property type and the market. And so this is far from played out. I'm expecting, I hate to forecast, and I'm not going to, but I have sort of an institutional cynicism about me. And when you look at the market mavens on TV, I think we're far from being through this whole event. The valuations in the marketplace across asset types confound me in the face of our current unemployment, which has a direct impact on occupancies and job growth and so forth, and commercial real estate. And I think this is a long way from playing out. And so how long does this downturn or cycle take? I don't know, but I think we're at least a good couple quarters before we see this thing sort of stabilize and adjust. Notwithstanding that, multifamily continues to perform, for example, but there's big question marks there as stimulus runs out, and forbearance and deferrals on rent payments that have been implemented and mandated by the feds either don't get renewed or run out. And so evictions are beginning to increase. And so what that means for family tenancy, rents and vacancy is an unknown. You can sort of see how that plays out, but does it play out in the way we think? I don't know. Industrial is super stable with the increase in e-commerce and people staying at home and continuing to buy goods online. Office, again, is a longer duration question. Hotel, a very long road to recovery there. A retail exposure is in a good position, notwithstanding some of the mall exposure we have. And, it's part of the cycle. I don't think we're going to adjust or revalue the way we did during the GFC, but we're definitely readjusting now. Our core funds came in, their second quarter numbers were down anywhere from 1% to 2.5%. Our value add funds have taken, aggressive positions on their valuations from not writing anything down to, down as much as 14%. And I expect that to continue before we see a stabilization. So I know that was a long-winded response. Hopefully I hit the high points and answered your question, but please help me redirect if I did not.
Ethan, this is Jim. Could you maybe let us and the board know what to expect with respect to how the numbers will come in over the next 3 quarters? Not specific numbers, but the direction as the rolling appraisal process rolls through the properties, particularly in your core funds, but just generally speaking, and what the board might expect with respect to leverage risk, that in terms of loan to value. How should we prepare them for what those numbers might be?
Well, thanks for the question, Jim. I thought I had alluded to that as far as being a couple quarters out from value stabilizing. So to be super direct, expect the downtrend to continue. As far as leverage is concerned, we've got what I would consider to be a pretty conservatively levered portfolio. You can see that on page 29 of the presentation. Overall debt in the portfolio is just over 50%. So, we've got almost 50% equity subordination across the value of our portfolio. So while that's on a total portfolio level basis, you know, and we've got different segments of the portfolio that have different leverage ratios. If you just think about it holistically, you know, you'd need to see more than a 50% decline in values before we were at risk of, you know, really seeing defaults and loan to own type distress in our portfolio. You know, the core portfolio, 26% leverage, the non-core portfolio, 63% leverage. That's, you know, 30% equity, 37% equity subordination. So I think, you know, you'd have to see values decline over 37%, which was probably in line with some of the equity declines during the GFC, in order to really think about seeing some significant, you know, default risk there. As far as it relates to any current contemplation of that, feedback from our managers, there aren't issues yet that I've been acutely made aware of. So I think we're in a good position there. And so board members, if you feel like I didn't address or properly set the expectations that Jim was asking me to, please let me know, and I'll give you more feedback.
And I'd like to go back to the commercial office space. It seems like that's the murkiest of all places, and maybe you have a different view of it. But I won't ask you to forecast, but merely talk about, you know, we're seeing so much confusion. Amazon's talking about more office space, and Google's sending everybody home for a year. And what will you use to help you determine whether this is going to be a long-term change in commercial office space, or merely a blip that a year from now we go, oh, everything's back to normal?
Forgive my pause. I'm just, I guess, Jim, to really answer your question, what I use is the expertise of our underlying managers and what they tell me during live conversations and what they write about in their quarterly reports, as far as what they're seeing with their boots on the ground in the markets in which they are operating. There's no such thing. I mean, you could look at, I suppose, overall office vacancies that are reported on a quarterly basis from the likes of JLL and CBRE and Cushman and Wakefield, and that's maybe an industry metric that certainly I pay attention to. But you know, that can often, there's a lot of noise and nuance in those numbers. So I don't know if that answered your question, but you know, what I'm hearing is a tale of two stories, what you alluded to. You know, there are those corporate users and those folks who are looking at the office market and saying, you know what, there's going to be more office demand. Not only basically, which the thesis is being driven by social distancing. So everyone's going to come back to the office, but the office corporate users are going to require more space for their existing workforce in order to account for a social distancing parameter that is likely to be, you know, present in our society and our operating environments for the foreseeable future. And then there are those companies that say, hey, look, we've, notwithstanding, you know, cultural aspects, leadership, quality, you know, traits that we can't pass on in an otherwise collaborative working office environment, we're doing just fine working from home, so we're going to require less space. And like I said, that's going to take some time to play out, and I don't think we're going to see that. I mean, this is my personal feeling. I don't think we're going to see that play out with any real transparency until COVID settles down. And what that means, I don't know. You know, you could pontificate about a vaccine, and, you know, then you think about, well, how effective is the vaccine, and what's going to be the uptake of the vaccine, and how does that play out in, you know, the human condition and movements of populations, both in corporate office environments or otherwise. And, you know, I'm not going to go there. We all have our views, but hopefully, Jim, I at least addressed your question and shared with you the perspectives I have.
I'd like to follow up with just one part, and that is in looking at our own portfolio of office space, is that almost exclusively big urban? Are we medium-sized urban, semi-rural? Is there any of that in the portfolio?
Yeah, you know, it's a smattering. There's definitely suburban office there. I'd say most of it is definitely more, you know, tier 1, tier 2 cities. The thing that's great about office is it's a very diverse user tenant base across industries. It's high credit quality, and so I think that will serve us well through time as this thing plays out. So maybe something else to address your question, Jack. So from a risk perspective in office, I feel pretty good about it because it is, you know, I guess you could look at it both ways, you know, particularly in the tier 1 cities, you could say, well, there's a human capital flight from cities. And so how does that bear out in the office user environment? And again, it's just, I don't know. And nobody knows. So at least I'm in good company, but it's largely tier 1 and tier 2 cities, Jim.
Thanks for your perspective.
Yeah, you bet.
Ethan, maybe one thing I would add that I think you kind of touched on it, but you know, when we're talking about office space, these are typically, you know, the clients that are in these buildings, they've got a lease, you know, so it could be a 5 or 10-year lease or something with options to pick it up for additional years. So it's not as if tomorrow, assuming that they're a, you know, going concern, and as Ethan said, most of them are probably investment grade, they're not likely to make this change overnight because they essentially can't. They're locked into their lease. So when Ethan's talking about this playing out over a period of years, I mean, a lot of that is tied to sort of the lease contracts that they currently have in place. Sure, they can go and negotiate, and maybe you've got, you know, certain tenants that want to leave and others that want to expand. So maybe there's room to make changes, but you know, effectively, I would say it's just not something that can play out real quickly here, as Ethan has, you know, clearly stated.
Good point. Thanks, John.
So I have a question, Ethan. This is Maggie. Where you talked about the fundraising fell to its lowest, the real estate funds fundraising, but yet dry powder is high. I mean, what's the impact of that, I guess? Help me understand it, because the real estate fundraising tells me that they're not going to have funds to do some of the things they want to do, but there's dry powder out there that some entities have.
Yeah, so fundraising has been impacted on 2 fronts, probably multiple, but the main 2 that I'm going to highlight are the following. So part of that has been impacted by institutions such as ourselves' ability to actually do proper due diligence, at least per their existing processes, to the extent they haven't shifted their paradigms. And what I mean by that, they can't travel and they can't do proper due diligence. And so they haven't been looking at new funds, for example, or haven't been arguably re-upping with existing managers that require them to continue to do on-sites and so forth. So just new deals, new capital hasn't been put to work in that sense of the word. And then people, I think, are also, you know, they've taken a step back and they're maybe frozen from a capital allocation perspective and not committing new capital because they have this great fear around valuations and how that's ultimately going to pan out. And so they're not committing new capital to new deals that will arguably start investing in this environment. So that's why fundraising is down. Now, dry powder has been what it has been for the past handful of quarters and years because, you know, we are at the tail end, or frankly, just transitioning out of what has been a huge upcycle in real estate, and people have been committing to new real estate in record amounts over the last couple of years since the GFC. And And that dry powder builds up through time because it takes a little while to ultimately deploy it and work through it. And so if this fundraising environment, this depressed fundraising environment is sustainable and lasts for the next couple quarters or couple of years, for example, you'll see that dry powder number come down as money is slowly put to work through the course of the coming years. Did that answer your question?
That was perfect. Thank you. I appreciate it.
So I think in the interest of time, we're going to have to move on a little bit. I know this is an important topic, but I think I can speak for Ethan and all the staff. If there's any questions from any board member, they're certainly willing to answer those one-on-one now after the meeting or really anytime.
Absolutely.
And so, John, keep us on. You know, my reputation for being done early is blown.
Right. All right. Well,
I
natural
feel
resource.
responsible for that, Jack. I feel partly responsible. So Jack, does that mean you'd like to move on to natural resources or just?
That means we would like to move on to natural resources, and I've got hundreds of questions.
Okay, well, in similar fashion, I'll just open it up. You know, guys, if I may, Jack, I just want to point out one thing as it relates to real estate. We did make an $8.5 million investment in a pre-IPO opportunity in a cold storage industrial private REIT. So that's not in the book. I wasn't sure if that was going to come to fruition before the materials got printed. It ultimately didn't, I think, but it has been consummated. And so just in full transparency, wanted to make you all aware of that. If there are no questions there, in similar fashion, I'll open it up to the board to ask me anything you'd like about natural resources, and I'll do what I can to share my perspective and answer your questions fully.
Ethan, are there, in the energy standpoint, are there more opportunities coming up for renewable investments as opposed to oil and coal?
Yes. Oh, so glad you asked that question, Jeff. It's near and dear to my heart these days. And so without getting too emotional and giving you a long story about how my philosophy has been shifting over the last few months, I'll tell you, that's pretty much as it relates to energy. That's really the only place I'm spending time. Emily and I are spending time. It's all about renewables going forward. I frankly would be any activity in the oil and gas space going forward will be very minimal as far as new activity. And it'll all be renewable focused. You know, as a reminder, we have Denham's International Power Fund in our portfolio that is completely focused on renewables in the emerging markets, developing independent power projects, solar, wind, hydro, et cetera. We're currently in diligence on a renewables group based in Copenhagen, which basically develops nothing but renewables in the developed markets, has 20-year holds. And so, you know, to John's point earlier, Jeff, you know, the market is moving there for sure. And so we're moving there. Oil and gas hasn't been a huge, it's been a detractor, frankly, from our portfolio through time. And while that's not going away and it will likely always be in the portfolio, the ongoing efforts in energy, 100% renewable focused, there's a real cool aspect to a lot of these deals that we're doing, which revolves around long-term, predictable, durable cash flows that will, you know, on an unlevered basis, deliver current income yields in the 5, 6, 7, 8, 9% range. And with minimal leverage, you know, you can add a few hundred basis points to that in certain circumstances. And so really focused on the renewable space. I'm really hoping that by year end or certainly early in 2021, I will be telling you guys about a big investment that we're going to hopefully make. Early days and diligence in the renewable space, very long duration, 20-year holds of these projects, basically holding these projects through their commercial life within a fund structure. So it really has a great asset liability matching perspective. It's got great current income yield characteristics, and it's all renewable. It's in the US, it's in developed countries. And so I know I've said a lot and I've probably repeated myself a couple times, but I'm pretty excited about where we're going there. We continue to look at other opportunities to diversify away from our oil and gas exposure. And renewables is part of that effort, as has been our aggregate strategy and our mitigation banking strategy. And not to let the cat out of the bag, but we're spending some time looking at cattle as well. So anything else I can address for you there, Jeff? Hopefully I answered your question.
Great.
The methane?
Anything else I can answer for the board?
Okay, thank you, Ethan.
All right. Thanks for the indulgence, and pardon the small interruptions there, but yeah, I look forward to chatting with you all a little bit later. Thank you.
All right, Mr. Ramasco, core fixed income.
Thank you. I will be brief. I think everybody's covered the background of the markets during the quarter. Suffice it to say, tale of two quarters, first and second quarter, where we saw a dramatic spread widening, followed by dramatic contraction. For the year, we had good performance in core fixed income. One of the big contributors was a very strong quarter from our external manager, Reams, who had put on quite a bit of corporate credit exposure, kind of at the worst of times. Took it off a little bit early, but enjoyed very good returns. Also, for the year, we saw interest rates decline very significantly, and that resulted in good performance for fixed income assets. Going forward, the portfolio is a little less credit heavy than it was. It's quite a bit less credit heavy as Reams reduced their credit exposure, their corporate credit exposure. Also, the internal fund has reduced its corporate credit exposure somewhat, as it is difficult to have faith that the now tighter spreads will hold throughout the recession. We are also slightly below the benchmark in terms of duration, so that means if interest rates continue to decline, we will underperform. If they go up, we will outperform. If they stay stable, not much will happen. We have made a somewhat of a projection on stable interest rates through the next year or two. That is expressed through our increased allocation to residential mortgages, which historically perform well in stable interest rate environments. Any questions then on core fixed income?
Seeing none, guess we'll go on to non-core fixed income with Randy.
Maybe not.
Can't hear you, Randy. I don't know if you're on mute or.
Okay, now can you hear me?
Oh, flashback to last time.
No kidding. Michael had that honor this time around, I think, but non-core fixed income, won't say a whole heck of a lot about this, given that it was talked about yesterday. I guess the bottom line is that spreads blew out, as you know, over 1,000 basis points. And John and I went to work and put money to work in the various funds in the various high yield managers we have. Through that period, the spreads have rallied back, similar to the stock market, but not quite as strongly. Still around 500 plus versus treasuries, which still is a fairly attractive rate, but a fairly attractive spread. But you can see that definitely things have rallied back in high yield. Thing to watch for in high yield going forward is the default rates. We talked to our managers this quarter about that. Seems like the industry is estimating a range of 8 to 12% defaults in high yield. Our managers, all three high yield managers, were in agreement separately, of course, and we asked them that it's probably going to be to the low side of that now rather than to the high side. So 8-9% default rates is what our external managers are thinking at this point. And like we've been saying for more than a few quarters now, that energy credits are the ones that are most vulnerable. As far as individual managers, only thing to say about that is for the yearly numbers as a group, they outperformed, underperformed during this rally in the last quarter, the second quarter calendar year. Overall, the defensive nature has worked for these portfolios. I would say that I wish it would have worked better. I wish we would have seen more downside protection than we did. If you look at the longer term numbers, the non-core asset class, which is at this point just simply high yield, underperformed the benchmark a bit in the longer periods. And that's because it was such a great run in high yield there for a while that these defensive portfolios lagged. So when things ran into trouble, particularly in the first quarter there and beginning of the second quarter, kind of hoped that those portfolios would make up more ground than they did. Talk to the managers about that, and sometimes it takes time to work these things out, and especially with some approaching inevitable bankruptcies that we just talked about, or I just mentioned, that the defensive nature that these portfolios have should, I would expect it to start to pay off a bit more here going forward. As far as the overall asset class, and the plans there you discussed yesterday, and still working on the emerging market debt and working on preferred stock as well as additions to the non-core asset class category. Any questions on non-core? Just because it's non-core doesn't mean it's non-important. Just had to throw it in there. Okay, seeing none, hearing none, let's go to domestic equities. Everybody very familiar with how the equity markets have rallied. We're pushing into new high territory again on the S&P 500 as we speak. And I agree with Dan Zarling and John on the valuation concerns in the equity markets. It's very highly valued at this time across in the aggregate numbers, and those earnings estimates that the high PEs are being calculated on are pretty generous, as I've said even last time. So, I mean, basically what we're looking at is, stock investors, they're looking at everything's going to be okay. We're going to have a V-shaped recovery that continues. We're going to have a vaccine within 6 to 9 months that everybody's going to take. And everybody's going to go back to flying on airplanes and going back to work and sitting with each other. So, it's, we talked basically everything that could go right is I think is in the market at this time. There are some technical indicators that are definitely flashing that were overdone and ready for somewhat of a pullback. With that said, I mean, there's a lot of money on the sidelines, and as John alluded to, John Putnam, when people look at their asset allocation, where are you going to go? I mean, rates are so low. You heard Ethan talk about real estate, and bottom line is people are riding the trend of the Fed is your friend and don't fight the Fed, and they're buying stocks when they get a chance. When things pull back a little bit, they put money to work. They can get a dividend there that assuming stocks don't underperform from here, they get a dividend that's at least as good, and in some based on some fixed income durations, better than being in fixed income. So this could continue for a while. To answer Bruce's question a little bit more, a narrow market typically has never been good for the stock market. I mean, it's basically telling you that the stock market is not healthy, and that not everybody is participating in prosperity the way that the big 5-6 stocks are. The debate against that line of thinking is that, hey, these stocks are, they're the megas, and technology is the world now, and it's going to continue even more given the new COVID era or the post-COVID era, and so those valuations are deserved. Maybe I buy part of that, but again, the world economy is made up of things other than tech stocks, and it's made up of products and services other than technology. And if those areas don't improve, then I think the market could run into some problems going forward. With that said, what do you do? We've done really well on a peer group basis because we've been largely passive in large cap, and so we've enjoyed the FANGs and their effect on the benchmark to some extent. But there is a reason to have active management, and I think we could see that here going forward, where we should have some active managers in there, and we try to have some that make their active decisions, I guess, or their calculated decisions on how to diversify and where to take risk. And I'm glad that we have those with us. It's interesting to see the performance of the active managers that we do have in domestic equities as well as international. I'll talk about in a second, because the managers that are more growthy, they've done better, and the managers that are more valuation conscious have not done as well. And that just goes right along with what we're seeing in the markets, where the value stocks, the value type industries to invest in just haven't performed like the growth areas have, particularly tech. So with that, I guess I'll stop for a second and see if anybody has any questions.
Thanks, Randy, for addressing that issue.
Yeah. As far as our individual managers, no changes at this time. And we did take some money out of domestic equities, as John mentioned. Most of that, in fact, all of it came from passive areas and the ETFs that we carry within there. When we move money like that, we like to use the ETFs because I can go to work from a trading perspective, and we can get better execution and better prices when we do that during the day, rather than notifying a manager account and getting a closing price of the next day. That's just the way it works with accounts versus actual securities that we're trading. So with the way the markets were volatile on a daily basis, that was the best course of action, was to take money from those ETFs when we had the chance. If there are any questions further questions on domestics, I'll move to international. Okay, let me scroll down here. International saw rallies in the quarter similar to the U.S., except not to the same degree. Again, the best house on the block is U.S., and at times like these, even though you did see a big rally and continue to see it, people are concerned about quality, and of course, the U.S. has those big mega cap stocks too that are doing the best. So it's not really a mystery out there. If you want to make money, at least in the short term, what stocks do you want to be in? With that said, the valuations comparatively international stocks, they're cheaper than U.S., but they are elevated too. And at least in my opinion, I think they're elevated more than they should be. So although international stocks look like they would be a bargain to U.S., that's not necessarily means that they're a bargain overall, given what kind of a situation we have out there. And they are implying a lot of, if not 100%, positivity economically and consumer sentiment wise. So kind of seeing the same thing in international, but not to the same degree in U.S. Same thing with our managers. The managers that are more growthy, they did well. The managers that are more value oriented, they didn't do as well. And it just kind of seems like I've been talking about this for a while, but that's the way it is in the equity markets at this point. The performance of the pool actually pretty good. I mentioned here, we're right across the board doing better than the benchmark in all areas from quarter all the way out to 10 plus years. So that's worked good. Active management is paying off there. We may want to think at some point of carrying a bit more active management in international, because the managers there have been performing well, and it's an indication also that active management as a whole in the international space seems to be paying off more so than in the domestic stocks. No changes planned with our manager lineup there. Like I said, I'm pretty satisfied with it at this point. And I guess that's about it for international. Any questions specific to international or any equities in general? Good, you guys are taking it easy on me.
Excuse me. Are we looking at Invesco improving their performance?
We are. Invesco is a case in point of a growth manager who stresses valuation more than your typical growth manager. And therefore, as growth continues to do so well, they're going to lag. They are probably, guessing they would say definitely, but they're probably at the bottom of their performance cycle in that respect. I'm a bit surprised that they didn't do better to the downside when the markets came down so quickly in the first part of the year. But I still think they got a good group there, and this will be one of those where this time will tell. I think where it should be their time when things do slow down a bit and people start to pull back from some of these growthier, more expensive names. They should do better for us.
Okay, any other questions for Randy? If not, we'll move on to Kirsten and Stip.
Good morning. Can everyone hear me okay?
Yes.
Awesome. I've had some connectivity issues this morning as well, so wanted to double check. I'm on page 52 of the investment update. It's page 302 for those of you online. I'll start by saying when I look at the performance, the yield on STIP at the end of June was still 54 basis points. We've fallen to about 30 basis points now. as Randy just said, there's a lot of cash on the sidelines. That means it's invested in the same things we're investing in STIP. So yields just continue to drop. There's kind of low supply. A lot of the corporate names that might issue CP when the yields dropped to near zero and the yield curve was so flat, a lot of these corporate names took the opportunity to term out their debt. So we no longer buy it in STIP. We might have bought it in core fixed income, but the spreads were so tight we didn't most of the time. As far as characteristics in STIP go, it looking very similar than it has for quite some time. We're pretty heavy in agencies and treasuries just because there's not a lot of, you're not getting paid for the risk currently. Are there any questions about STIP today? Trying to keep it short for you guys.
Is there any, been any defaults or anything concerning with extra risk in the portfolio?
No, not in STIP recently. We keep a pretty close eye on all of our names, and as you know, we're very high in quality. We did tap the reserve. I don't know if that was earlier this quarter or maybe last quarter, due to an external factor. And I'm not sure if
So
John...
I assume we're in talks to get some of that money back. How is that going?
That is above my pay grade. I'm not sure how the talks are going, but maybe Putnam or Willa can answer.
Talk to that, or?
Yeah, not well. I think there is a failure to admit an error on the part of the party who erred. And I don't know that we have much recourse under our current contract to do anything like withhold fees or something of that nature. So we did use the STIP reserve to make sure that we made the participants whole and that there wasn't busting of the buck. But relative to getting any of the funds refunded for the calculation error on their part, I don't think, let's put it this way, I don't think we should hold our breath.
Can you remind me the amount?
It was about 127,000, wasn't it, John?
That sounds right.
Go ahead, Kirsten.
All right.
And
I
was
think
that, excuse me, was that State Street? Is that who that was?
Yes.
Yeah, okay. I just wanted to remember, thanks.
Yep.
And he holds his head.
Yep, and I just want to put out a reminder that since the tax payments were delayed until July, that's when we would see this year kind of our the local government usually has a bump. It's twice a year, always when tax payments are due for a percentage of STIP. And so this year, instead of being in May, it was in July. Right, that's all I had to say. Thank you.
Other questions for Kirsten?
She does own trade.
Thanks, Kirsten. So state fund, I talked a little bit about that earlier. So continuing to add to mortgage backs here over time. We got our initial investment into the high yield asset class very, very shortly after you gave us approval in April to add that. That's been very additive to the portfolio so far. Wish we'd probably done more, but it was a good one nonetheless. We'll probably look to do some more there as we see further opportunities, but other than that, everything's going fairly well within the state fund portfolio overall. So happy to answer questions on state fund if anybody has any. Seeing none, I will let Mr. Ramasco take us home with trust fund.
Well, it's not often you get a chance to get retribution on your acting chairman, but every minute I drag this out is a minute against his performance, so. But given the rest of you, I will try to be brief. An observation, we've heard a lot of talk about low interest rates and how they might be as low as they're going to get, or they won't go lower. But please do keep in mind that they could go a lot lower. They could go negative. Long-term rates could go to zero. There's tens of trillions of dollars of negative yielding securities around the world. The front end of the Treasury note curve, about 3 months out and in, is yielding negatively. So that being said, that is the thing that we're most worried about in the trust fund investment pool. So we've wanted to guard against the declining rates. How we've done that is reallocate towards opportunistically towards high yield. And we've got an excellent opportunity to do that in the late first quarter and early second quarter. Also, we've allocated and intend to continue to allocate more towards real estate. We were able to do quite a bit of that early in the first quarter. We put Emily and Ethan kind of in a difficult spot by saying, how quick can we do it? Hurry, hurry, hurry. And then tapping on the brakes saying, wait, we don't want to do it. We don't want to do it. Going forward, we still expect to allocate a very significant portion to that, but we've deferred to Ethan and Emily regarding the valuations of real estate, and so think that maybe that will go a little slower for the rest of the year, but in the long run, I think we're going to have good timing on additional real estate investments. As far as performance goes, if you look at this relative to, say, core fixed income, you'll note that trust fund investment pool performed core largely because this portfolio has more risk assets, particularly corporates. And also, as we increase liquidity in the portfolio so that we could fund other asset classes, we missed a little bit of the comeback in spread product as well as in declining interest rates. Any questions?
John, did I understand you to say that in treasuries, that the very short term actually have negative rates? Did I understand that correctly?
In treasury notes, not treasury bills, but treasury notes, yes. I looked this morning and everything out through October had a negative yield.
Wow.
Maturities through October, I should say.
Thank you.
Want to wrap us up, John?
Well, one thing I might add that I forgot was Randy had mentioned in high yield, some of the underperformance versus the benchmark, and this has been true within kind of state fund and trust fund too. So one thing you have to remember is so when we go to fund a manager and we say we're going to give them, 25 million, we drop 25 million on them in a day. And throughout some of the second quarter, when we were giving them money for high yield, giving the high yield managers money, we start the performance clock the day that we give them money. But the markets are moving so quickly that there were days in there where the return for the day might be 4 or 5% because spreads were tightening rapidly. And so they can't get that money to work as quickly. And so there can be they look like they've underperformed versus the benchmark, and I guess they have, but it's simply, they can't get the money to work fast enough in some instances. We certainly noticed that in the second quarter. And so that at times hurts us. That can be true of some of our equity managers and things as well, just those timing differences. So not something we're really concerned about. Long term, it kind of washes out and should all be fine, but just something to be aware of. Sometimes those even the long-term performance differences, Newberger, I can remember from way back when GFC, we got a 40% return, but the market returned 55 or something, so just a note that happens, and we're okay with it because we understand why, and might make the performance numbers look a little worse than they actually are in my view. Other than that, nothing else from me.
Okay. So the next thing is a wrap up. I know, Dan, you've got a few things for us to.
The only thing, Mr. Chair, the only thing I've got on our list is commits versus deployed fees within private investments. We owe a follow up on Diane's question. Is there anything else from the board that staff needs to follow up on? Okay,
No,
we will include it.
Okay. Anything else? If not, I'll call the meeting adjourned. Thank you all.
Thank you.
Dan wanted to talk about the meetings for next year.